Welcome to Smart Investing, where we guide you through the world of stocks and portfolio basics with clarity and confidence. If you're between 36 and 55, perhaps juggling family budgets and future dreams, investing might feel daunting, like planning a long road trip without a map. But today, we'll chart that course together. Imagine building a portfolio as diversified as your daily meals, a mix of essentials and favorites to keep you nourished through any weather. Historically, the stock market has rewarded patient investors. The S&P 500 has delivered about 10% average annual returns since 1926, but going solo on single stocks can be risky. Diversification spreads that risk, like not putting all eggs in one basket. In this video, we'll walk you through creating a balanced portfolio step by step, backed by data, so you end up empowered and excited. Let's start with the fundamentals. Building on our road trip analogy from the introduction, let's understand why diversification is your essential GPS. Just as you'd pack a spare tire and snacks for the journey, a diversified portfolio protects against market bumps. Data shows that undiversified portfolios can lose up to 50% in downturns, like the 2008 crash, while diversified ones recovered faster, limiting losses to 20 to 30%. Think of it like your household budget. You don't spend all on groceries, you allocate for rent, savings, and fun. In investing, this means mixing stocks, bonds, and more. According to Vanguard, a simple 60-40 stock-bond split has historically returned 8% annually with lower volatility. We'll explore these building blocks next, ensuring your portfolio grows steadily, much like compounding interest in a savings account. You're not gambling, you're strategically planting seeds for long-term harvest. Stay with me as we dive into stocks, the growth engine of your portfolio. Following our discussion on diversification's protective role, let's focus on stocks, the dynamic part of your portfolio, akin to the accelerator in your family car. Stocks represent ownership in companies, offering growth potential through rising share prices and dividends. Historically, U.S. stocks have outperformed other assets. The Dow Jones has climbed over 1,000% in the last 50 years. But remember, they're volatile like traffic on a busy highway. To diversify within stocks spread across sectors, tech for innovation, healthcare for stability, energy for resilience. Data from Morningstar indicates that sector-balanced stock holdings reduce risk by 15 to 20% compared to concentrated picks. For someone in their 40s planning for retirement, aim for 50 to 70% in stocks, adjusting as you near goals. This isn't about picking winners, it's about broad exposure via index funds. As we move forward, we'll see how bonds add the brakes to this vehicle, creating a smoother ride. Shifting from the excitement of stocks, let's add bonds to your portfolio, like the steady paycheck in your monthly budget that covers essentials without fail. Bonds are loans to governments or companies, paying fixed interest over time. They're less volatile. U.S. Treasury bonds have returned about 5% annually with minimal losses during stock downturns. In 2022's market dip, while stocks fell 20%, bonds cushioned portfolios, limiting overall drops to 10 to 15%. For midlife investors, bonds provide income and preservation, ideally 20 to 40% of your mix depending on risk tolerance. Think of them as the reliable family member who always shows up. Combining stocks and bonds creates balance. Studies from Fidelity show this duo weathers storms better than stocks alone. Next, we'll explore ETFs, the efficient way to package these assets, making diversification as easy as online shopping. With bonds grounding our portfolio like a solid foundation, enter ETFs, exchange-traded funds that bundle stocks, bonds, or sectors into one easy trade, much like a pre-made meal kit for your investment diet. ETFs offer instant diversification. For instance, the SPY ETF tracks 500 top U.S. companies, mirroring the S&P 500's 10% historical returns at low cost, fees under 0.1%. BlackRock data reveals ETFs have grown assets to $10 trillion globally, popular for their liquidity and transparency. For busy professionals in their 50s, they're ideal. Buy one share for broad exposure without stock picking stress. Allocate 30 to 50% to equity ETFs for growth. This builds on our stock and bond talk, creating layers of protection. As we progress, consider international ETFs to avoid home bias, expanding your horizon like adding global flavors to family dinners. Extending our ETF efficiency, now let's balance risk and reward in your portfolio, similar to adjusting your car's speed for a safe, enjoyable drive. Risk tolerance varies by life stage. At 40, you might handle more stocks for higher returns 7 to 10%, while nearing 55, tilt toward bonds for stability 4 to 6%. The Sharpe ratio, a key metric, shows diversified portfolios achieve better returns per unit of risk. For example, a global ETF mix scores 0.8 versus 0.5 for US only. Historical crashes like 2000's bust highlight this. Diversified investors recovered in 3 years, others took 7. Use tools like Vanguard's Risk Profiler to gauge yours. This equilibrium fosters peace of mind, ensuring growth without sleepless nights. Next, we'll model allocations, turning theory into your personal blueprint. From balancing risks, let's construct portfolio allocation models, like dividing your monthly budget into categories for harmony. A classic is the 60-40. 60% stocks for growth, 40% bonds for safety, yielding 7 to 8% long-term per Morningstar data. For conservative 50-somethings, try 50-50, aggressive 30-somethings, 80-20. Add 10 to 20% international for global diversification. Emerging markets have returned 9% annually since 2000, per MSCI. These models aren't rigid. They're starting points, adaptable like family plans. Fidelity's research shows target date funds using similar allocations retire with 20% more wealth. Visualize yours, input goals into a brokerage calculator. This structured approach demystifies investing, paving the way for maintenance strategies ahead. Having modeled your allocations, rebalancing keeps your portfolio on track, like annual checkups for your family's health. Over time, winners like stocks grow, skewing your 60-40 to 70-30, increasing risk. Rebalance yearly or when drifts hit 5%, selling high and buying low. Schwab data indicates this boosts returns by 0.5 to 1% annually without extra risk. It's simple. Use ETF trades in your app, costing pennies. For example, post-2020 rally, rebalancers captured gains while protecting against corrections. This discipline, rooted in behavioral finance, counters emotional decisions. As we approach potential pitfalls, remember rebalancing sustains the steady growth that compounds $10,000 to over $76,000 in 30 years at 7%. With rebalancing as your maintenance plan, avoid common mistakes that derail portfolios, like chasing hot tips instead of sticking to diversification. Think fad diets versus balanced nutrition. One pitfall, overconcentration. 40% of investors hold too few stocks per DALBAR, leading to 4% underperformance. Another, timing the market, which studies show fails 80% of the time. Consistent investing wins. Emotional selling and panics, as in 2022, cost many 15% more in missed rebounds. For your age group, ignoring fees matters. High-cost funds eat 2% yearly, having retirement savings. Stay data-driven. Follow index benchmarks. These errors are avoidable with our framework. Now let's simulate a portfolio to see it in action, bringing clarity to your path. Avoiding those mistakes, let's simulate your diversified portfolio, like test driving a car before the big trip. Start with $10,000. 60% in S&P ETF, expected 10% growth, 30% bonds, 5%, 10% international, 8%. Over 20 years at 7.5% blended return, it grows to $43,000 per compound calculators. In a downturn scenario like 2008, losses cap at 25% versus 50% undiversified, recovering quicker. Adjust for your budget, monthly $200 additions supercharged to $100,000. Tools like Personal Capital visualize this free. This hands-on view reveals the power of patience. Markets rise 75% of years. As we near key insights, feel the empowerment. Your portfolio isn't luck, it's strategy yielding real security. Through our simulation, the climax emerges, key insights for lasting success in portfolio building. First, diversification isn't dilution, it's amplification. Harvard studies confirm it cuts risk by 30% while preserving returns. Second, time is your ally, starting at 40 with modest sums. Consistent investing at 7% reaches millionaire status by 65 for many. Third, stay informed but not obsessed. Quarterly reviews suffice, avoiding noise. Data from the CFA Institute underscores, emotional control adds 1 to 2% to performance. For your life stage, prioritize tax-advantaged accounts like IRAs, growing tax-free. These pillars transform uncertainty into clarity, much like a well-planned family legacy. With this foundation, you're ready for takeaways that propel action. Culminating our journey from basics to insights, here are actionable takeaways to build your diversified portfolio today. 1. Assess risk and start with a 60/40 ETF mix via low-cost brokers like Vanguard. 2. Automate contributions. $100 monthly compounds powerfully. 3. Rebalance annually, avoiding emotional trades. Track progress with free apps. Remember, like nurturing a family budget, consistency yields security. Data proves diversified investors sleep better and retire richer. You've gained the tools, now take that first step toward financial empowerment. Thank you for joining Smart Investing. Subscribe for more guides on stocks and portfolios. Comment your biggest takeaway below. Invest wisely, live confidently.